Hey everybody, welcome to the financial vlog. Today we are going to talk about the concept of covered calls. This concept is going to be explained for beginners, and we are also going to cover how to actually transact this using a tool, Robinhood. Covered calls are something which billionaire investor Warren Buffett has been said to be using a lot and making a lot of money using that. This is a tool which allows people relatively consistent, safer, and long-term dollar returns. Of course, there is no investment without any risk, but these are supposed to be relatively low risk and safer bets for you to earn returns on your investment. Let us go to the next slide. Okay, this a further explanation is going to be brought to you by Financial Vlog. I would request you to like and subscribe. It really helps me out in YouTube algorithm and continuing to make all these videos. So, first point, what is the concept of the covered call? What is a covered call and what does it mean in layman's terms? So, let us say you have some money to invest. Okay, let us say $1,000. Now you can buy a stock using any tool. Let's say in this example Robinhood, of company, let us say company XYZ, right? And you can hold the stock for some time for the price of the stock to go up and let it appreciate. In many stocks, you can also earn dividend on the stock while you are holding the stock, right? Now, this is basically the regular investment or a regular buy and sell. The covered call basically falls under the derivative instrument. What does that mean? That means that it is a tool used over and above the stock purchase which you have made to gain more profit or make more money out of it, right? So covered call is basically a type of a contract which you can sell after you have acquired at least 100 stocks in some company, which is in this case I'm just calling it XYZ, right? So basically, once you have acquired at least 100 stock in this company, whatever company, let's say XYZ, you can sell something called as a covered call or a contract. Now, who buys this contract? Whoever buys this contract, it helps the others, that is the buyer of this contract, to bet on the price increase of the stock XYZ, which actually you hold instead of this other person holding it. It allows them to expose them, in the sense it allows the buyer to expose themselves and bet on the price increase of stock XYZ with relatively lower investment. Okay, and it helps you because in order to enable the buyer of this contract to take this bet or make this bet, the buyer of this contract will pay you a commission. So I hope at very high level this gives you an idea. Covered call is something which you do after you have already bought the stock and you are holding a stock of company XYZ. Uh, we are not talking of which company to buy the stock for here. The company XYZ should be a company which you would choose to buy the stock for, right? How to choose that company is a different discussion, but relatively you should seek for covered calls. Relatively, you should seek a company which is stable and financially sound company, preferably something which pays dividend. I will try to link a video later in the next slide where we can talk about how to choose a company, but that will be a separate topic. This particular presentation is going to talk more in depth of what covered calls are and how do we actually execute it using Robinhood. So if this definition is not super clear, stay with me as we proceed. It is going to get more and more clearer. Okay, next slide. So we will use some example in order to proceed. Let us say you have $1,000 to invest. Now, I mean, you can have $100, you can have $10,000, and you can adjust this example to your need accordingly. But uh, for this example, which is the examples in the slide, we are going to assume you have $1,000, and I'm going to show you some diagrams on them. Um, the idea is to make maximum return on this $1,000. So let us say you set aside this $1,000 for a month, for a week, or for a year. Um, you want to make maximum amount out of it with relatively lesser risk. So basically, 1% of $1,000 will be $10, right? 10% of $1,000 will be $100. So and so on. The idea is to increase the percentage gain on this $1,000, right? Um, Now, let us say you have a trading account. It can be in any website, but for this example and this slide, we are going to focus on Robinhood and talk through after we explain the concept of call options, we are going to talk through how you can actually transact for this call options and make money using the Robinhood as a trading platform. Okay, let's go ahead. First, you should think long term and buy shares of suitable company. So in this example and earlier slide which I spoke and mentioned, we are saying you want to buy a company of XYZ stock. The suggestion here for buying the company XYZ stock is not ideally a penny stock, something very fundamentally strong, stable, and financially sound. Ideally, you also want to look for something which provides you the dividend. So while you're just waiting on it and um, uh, the covered call is doing its job, you probably still keep getting the dividend. Okay, so that's the idea. In this example, we will buy for a company, a stock of company XYZ. We will assume that one stock of this company XYZ was $9, right? So that means if you have to buy 100 quantity, you will end up paying $900 for buying the stock. We are assuming no commission here, right? And which is true in case of if you are using Robinhood, which would stand true. Um, Next is it is important that for doing any kind of covered call, you have at least 100 quantity. And if you want to do more covered calls, you need quantity to be in multiple of 100. So you can have 100, 200, 300, 400, and so on. Okay. So to summarize, you need to select a stock which you actually want to buy in at least 100 or multiple of 100 quantity, and it has to be a relatively stable, fundamentally strong financial company, preferably something which can pay you the dividend. Now let's go to the next slide. So on how to choose this XYZ company, uh, as I mentioned earlier, we are not going to cover in this video, but I have a separate video on this channel, and you can click here on the right side top. There will be a gray pop-up, and that should take you to the video on how you can select the stock, which is a separate video. But you can use that video, or you can choose the stock on your own, or make a decision on your own. I'll leave that up to you. Let's go ahead with the covered call for this video now. Okay, so the concept of the covered call is basically selling a call option. Okay, so now I'm going to explain all that to you with use of this diagram, and you should be able to see my mouse moving with around yellow color. Okay, so on the left side what I have is you as the person who is going to use covered call to make money. Okay, and on the right side what you see in orange is the market or somebody who is going to buy this covered call from you. And now I'm going to explain how it works. So you as a covered call, a person who is trying to make money from covered call is going to hold a stock of XYZ company. Okay, so if you see here, this XYZ company, any financially stable and long-term investment which you have, you at least need to have 100 quantity of the stock. Okay, so uh, so let's say you have XYZ company stock. You bought 100 quantity of the stock at $9 a stock. That means totally out of $1,000 you had, you have invested 900 dollars on the stock. Okay. Now your bet is now, and the current market price of the stock of course is $9 because you have just bought the stock at $9 per share or per stock. Now what you are going to bet is this stock might go up a little, go down a little in next 1 month, but it is not going to cross $12. That is what you are betting when you are trying to sell a covered call or when you are trying to make money out of covered call. Now this $12 can be anything, right? For a very basic understanding, assume that this $12 is something where you expect that price will ideally not go above in next 1 month, and if it does go above, you are okay letting go the profit which you would have got for it going above and beyond the $12. Okay, so I hope this clear. uh, Let me recap the last part again. You have bought the share at $9. You have bought 100 shares of XYZ company at $9 a share price, thus investing $900. And you are betting that in next 1 month, this price might go slightly up, but you are kind of sure that this will definitely not go above about $12, right? That is your bet. Now, what you will do is for this 100 shares, you will sell a something called as a call option contract. This contract will mention that you are willing to offer, by the virtue of this contract which you're selling or a call option contract which you're selling, you are willing to offer 100 shares at $12 a share price within 1 month if somebody asks to buy it. Now this is the contract which you are going to sell. Now let us look at the other angle on why would somebody look at buying it, right? Because you think that price is not going to go about $12, and that's why your bet is, and that's what you're trying to sell. Why is somebody trying to buy it, and why would somebody try to transact with you from the market? So now look at the right side, which is the orange person. Now, this is somebody who is a call option buyer, and you are a call option seller in this transaction or the covered call, right? So, the market call option buyer does not hold any stock, okay? Or at least for this discussion purposes, let's assume that person does not hold any stock. Um, Now they do not want to invest $900 to buy 100 quantity of XYZ company today, right? Either they do not want to invest it or they do not have so much money to buy 100 stocks of XYZ company and wait till and wait for 1 month for it to appreciate. However, this person in the market, this orange person in the market, believes that within 1 month this stock price will go much more than $12. They are thinking it might go to $15, $20 within 1 month, right? They have done some analysis, or they're just betting based on hunch. Doesn't matter to us. But the idea is this person has very little amount to invest, and they believe that within 1 month the same stock price is going to go way beyond $100. Sorry, way beyond $12. So now this is the person who is ideal for buying your call option contract or your covered call, because they see a win in doing this transaction. You also, because they think the price will go much beyond $12, right? 15, $20 something. And you are a person ideal to do this contract because you have the stock and you think the price is going to stay under the $12, right? Now this is the ideal scenario where the covered call transaction will happen for you. This is actually a call option contract transaction where you are going to be the call option seller, and the orange person or the somebody in the market is going to be the call option buyer, right? Now you are selling this call option contract, and you already have the stocks or the shares to support it, right? You have this 100 stocks held in your account, and that is why this is called a covered call, right? Because your the contract which you're selling is covered contract. Okay, now let us say this person, orange person or B person, is buying this contract for you, but they must pay some price to you, right? So let us say in this case they are going to pay you $50 to buy this contract, right? They're not buying the actual shares, they're just buying a contract which says they can call upon you, who is the seller of the contract, anytime within next 1 month to sell 100 quantity of XYZ stock at $12 per share price. Okay, so basically they will pay you $50, and which we call in the call option language as a premium. They will pay you $50, and in return they will buy the to right to purchase 100 quantity of stock at $12 a share within next 1 month. I hope this is very clear to you guys. Now, with this said, I'm going to familiarize you with some terminologies. So, the transaction of the call options only happens in lots. One lot is 100 quantity of shares. Okay, so that's the lot size. Second is this $12 which we spoke about is called as a strike price. Okay, $12 per share is a strike price. And the we are saying this is 1 month window, right? And within which this contract has to transact is called as a expiry date. Okay, I hope this is clear. Now, what will happen if the price goes up or down, etc.? We are going to cover in the next slides. So next slide is basically highlighting, it's exactly the same slide as earlier. It is just highlighting this $50, right? This is the premium which you are being paid, and this is the way you are going to make money as a covered call seller on your investment, in addition to the stock rising up. This premium of $50 is something you will make within a month if the stock price does not go above $12, right? So this $12 which you see is your earning, and that is the purpose of transacting in the covered calls. Okay, let's go ahead. Uh, so to summarize, what we discussed earlier, you sold the contract of company XYZ one lot which is 100 stock at strike rate of $12 a stock and with expiry date of 1 month to this person, and in return what you got is $50. Your bet was that this stock price will not go above $12 in 1 month, and the person who bought, their bet was that this stock price will go much more than $12 within a month, right? So that's when the transaction is happening of your covered call or your call option sale. Now, let us think through different scenarios that what can happen if the price goes above $12, what can happen if the price stays below $12 in this 1 month, or price is just exactly $12. In next slides, we are going to talk in detail through all those scenarios. So let us look at this scenario 1. Scenario 1 is if price does not go greater than $12 within this 1 month, right? What happens in this case is this $50 which were paid to you as a premium, you keep that premium. Why? Because as the price is under $12, there is no reason for this orange person to call upon you to sell the stock as $12, right? This person, orange person, can buy it from the open market for cheaper, right? And that is why this person not call upon you to sell the stock, and you would keep this $50 once this 1 month is over, and that is how you make money using the covered calls. Let us go ahead. Scenario 2, the price reaches $12. Now, it is not more than $12, it is not less than $12. We are saying it is exactly $12. Now, ideally, what will happen is this person can buy the stock from open market, or they can call upon you to sell the price at $12. But in ideal world, this person will not call upon you because they can just buy it from open market, and you will end up keeping this to $50, right? Uh, so because and the reason person will not do that because this 50, they will have to pay the some amount to take this delivery, right? Delivery of the actual stock. It might be easier for them to buy from the open market instead. So that's most practical situation in that case. Now let us take the scenario number 3, where price goes much higher, which is more than $12. Let us say it went to $15, right? Uh, Now what will happen is this person, orange person, is going to be happy. So what this person will do is this person will call upon you, say, okay, market price is the 1 month is not passed yet, but the market price is now $15, right? Uh, so now this person is going to call upon you for this call option, which or the covered call which you have sold, and the person will say, okay, market price is 15, now I'm going to call upon you, give me this 100 quantity of the stock which you have, and though the market price is 15, you will need to sell the stock at $12, right? So what will happen is you will end up keeping this $50 which was a premium, right? You will have to sell this stock to this person at $12. So that means you, if you remember, you had bought the stock at $9. So you will still make profit of this $50, which was the premium, plus 12 minus 9, which is 3, into the 100 quantity of the stock. So 300. So you will still make this $350 profit. However, any and every profit above the $12 you will not be able to make because you have to sell this 100 quantity of stock at $12 price only. That means because the price is $15, the profit here, which is 15 minus 12, which is again $3, that additional $300 profit is going to be consumed by the person who had bought this contract from you. Now, regardless that additional profit is lost and the extra profit is lost because of the price going super high all the way up to $15, you are still making money in this situation, right? I hope this shows you the value of the covered calls, um, and why and how it is profitable to you. Let's go to the next slide. Now, scenario 4 is that the price reaches uh, actually $6, right? This, instead of the stock price staying at $9, it actually reached way below, which is $6. Now, in this scenario, what is going to happen is you are going to keep the $50 which the person paid you as a premium. However, now you are going to make a unbooked loss, right? Because uh, 1 month ran out, the price never went above $12. Instead, the price went down and it reached $6. Now you cannot sell this stock earlier to at, let's say, $11.5 to make a stop loss, because you have this contract present, right? It You are bound to keep this stock in your account till this contract is live, that is within this 1 month, which was the expiry. So you will, on papers, or basically unbooked loss, you would be down by $300 because your buy price was $9, and the market price is $6. Now you have not yet sold the stock, but indirectly you have not the actual loss, but an unbooked on paper loss of $300 because the market price is 6 and you had bought it at 9. Now, why I'm saying unbooked loss is because you have not actually sold the stock. So it is just on paper. Because of the market fluctuation, it will show you your dollar amount is lower, but it doesn't mean you have actually booked the loss. Now, note that even in this situation, you have these $50 received as a premium, which is going to add to your account, and you are going to have that dollars available for you. Um, Only catch is that if something happens to this company during this time, and the price goes down, let's say, to just $1 instead of $9, then you are going to end up losing. And let's say you have to sell the stock on the 31st day, or let's say on the 32nd day of the month, where the month has run out. In that case, you could not sell the stock before. In that case, you are forced to take this loss of uh, $800 because the market price is just one at that point in time. This is the risk which you carry at the call contract, or basically the covered call, when you do, right, or selling the call option. So that would be your situation where you would make a loss. That is the advantage for this orange person, and that's why they try to do this transaction, because their risk is just, in our example, is just $50. They have invested very less, and they don't have the much of a downside risk if it, other than losing that $50. Um, so I hope this explains and covers how this works, when you can make profit, when you can make loss. Uh, Again, I mean, the any stock market, derivative market, or option market, they do have risk. However, if you have a stable stock and long-term stock, usually these risks are contained and much more manageable as compared to the other risk. So let's go ahead. Now, the point is the gain to you is huge, right? So in this example, if you see here, you made $50 from investing $900 in 1 month, which is 5.55% in 1 month. If you can do this month on month and frequently, you are going to make, which is 5.55% every month, you're going to make approximately 66% on your investment, which is 66% in a year, which is very, very good return, right? uh, of course there are risks, right? That means the stock price can go down, as we saw in scenario 4, and you end up holding it because you cannot sell it because of your covered call. However, if the stock is good and stable, this risk is manageable. Again, I cannot say it enough. This does not mean there is no risk. There is risk in the market. Do your own discretion, right? Uh, think through all the risks before you do it. However, in my opinion, this is a relatively secure and safer bet as compared to doing daily trading or or doing trading or other methodologies. That is why Warren Buffett is said to be using this method fairly largely. Okay. Uh, Next is if the stock price goes way up. So let us say in our example, if instead of stock price going to $15, it went all the way up to $100, $200, $300, right? In that case, and it just happened within this 1 month, right? There was an exponential growth. Some especially new product came up, or company launched something, or something really went well. In that case, it's an indirect loss because you are going to miss all this profit, because you have signed off that you are going to sell this 100 stock just at $12 price. That means anything over and above it, you will not make the profit. The person who bought this covered call or the call option contract from you is the person, the orange person, is going to make the profit in our example, right? So that is another risk which is possible here. uh, Now, the third point is basically your money is locked for this 1 month or till the expiry date. And that means that the premium of $50 in our example is paid by Robinhood at the end of transaction. That means at the end of expiry date, which is 1 month and not before. You will not get that $50 as soon as you create this contract, right? So that is something which you need to be aware of. Now let's go ahead. Before we proceed, I think I would request you guys to subscribe and like and comment how you find it so far. This really helps me out in the YouTube algorithm and to keep making more such videos. Okay. Now we are going to go through. Next is the uh, how to transact this in Robinhood. But again, really appreciate you subscribing, liking, commenting, say how you think. It really helps me out. Okay, let's go ahead now. So again, another point before we proceed, I'm going to put a link here on another options trading 101 and some other videos that might help you in more option trading concept. Right now, we are going to proceed with the how to do this transaction in Robinhood. Whatever we saw, how to transact for covered calls using your money, using your investment, and how to make money using the tool of Robinhood. Now, you can use any investment tool. Most brokerage accounts offer it. However, for this video, we'll talk through the Robinhood and I'll walk you through that step by step. So first, uh, in in our example, we said we will use XYZ stock, right? Sorry, in case I covered my mic, let me repeat it. In our earlier example, we said we are going to use the stock of company XYZ. Now, for this example and Robinhood illustration, I am going to say that this XYZ stock is a stock with the ticker symbol KALA. Now, I am not recommending KALA stock here or Kala stock here. This is just an example, right? This is not a stock buying advice. This is just an example. So, after you have bought that 100 quantity of that KALA stock, it will show you in your Robinhood account. This presentation or this video does not talk about how to buy stock. This is only about the covered calls. So it assumes that you know how to buy this KALA stock in Robinhood, or the any XYZ stock in Robinhood, and you already have it in your account. Now, in my example, I have covered certain fields for security purposes. However, I have left the KALA stock open for you to see. Here, if you see, I have 605 quantity of the KALA stock. Okay, it shows you here. Now, as I said, you must have 100 or multiple of 100 in order to do the covered call. So I have in this case 605 stocks or 605 shares. That means I can do maximum of 6 covered call sales using this. I cannot do anything with this extra five shares which I have, right? Um, and on the right hand side, what you see is basically the market price of this XYZ stock. So in our earlier example, which we used and spoke through using diagram, the stock price was $9 a share. In my example, which is the Robinhood example, the stock price is $3.48 a share. Now let us go ahead. Now, what you need to do in order to sell a call option or a covered call is basically click on this area where it shows you the share which you had, right? Just click in this generic area anywhere on this in this inside this red box, and then it will take you to the next screen. So the next screen will look like this. It will show you I have KALA or Kala Pharmaceuticals, and it will show me the stock price. It will show me its graph. And if I can also scroll down on this screen. If I scroll down on this screen, as you can see here, it shows me certain more details. It shows me I have this 605 quantity of the shares, right? I have my buying price of the share. Right now, I am in a kind of a loss making on this because the market price is around 3.48, right? As you see here. But uh, I had bought it at 5.3 of a average price. So I'm kind of a little bit uh, in lower price than what I had bought here. And my total equity value as of market is $2105.40, right? And that's what it shows. Now for next, we will go back and I scroll back up on my screen, and what we have here, this basically my family's account, right? So what we have here is a trade button. So what I would want you to do is I would want you to click on this trade button first. Once you click on this trade button, the next screen which appears over here is going to be the uh, it will give you three options: trade options, sell and buy. So now this sell and buy button, do not click on them. They are actually for selling or buying the KALA stock itself. But because we want to do the covered call, we are going to click on the trade options here, which is this button. Okay, let's go ahead. Now once you click on this, the next screen will appear. It will look like this. I want you guys to note certain points here, right? So on the top there's buy and sell, and then there is call and put. In order to do the covered calls or selling the call options, make sure that you have selected here a call on the right side top and a sell on the left side top. That means you are going to sell a call in order to do the covered call, right? Next thing you can note here is there are different dates and months here, right? So this is November 15, this is December 20, this is January 17, 2020, this is April 17, 2020. These are nothing but the expiry dates which we saw in our earlier example, right? Now, other thing which you can see here is the $7.5 call, $5 call, $2.5 call. These are nothing but the strike prices which we saw in our example earlier. And in our example earlier, it was $12, right? Now here in this screen and this actual live example, they are different values available, right? And what you see here on the right hand side, 0.13 or 0.05 or 1.10, is the premium you will get per share. That means this will be multiplied with 100 because you are going to be selling a call option for a lot of 100, right? So for example, if I try to sell a call option for selling my covered call at $7.5 strike price, uh, current ongoing premium rate in the market is 0.13, so I will get $13 at the end of November 15, if the price does not cross the 7.5. The current share price is shown here, right? 3.48. I hope this was clear. Let me do one thing. I will go in my next screen to another expiry date just to show you how the screens vary. So if you see here, this was the screen from the previous slide, right? Which was 7.55 and 2.5, and which was November 15. But if I go here, I just scrolled here in the expiry date, I check the January 17, 2020. Now there is also one more strike rate available there, which is $10 in this case. And if I try to sell call for that option, it will give me 0.35 per share, so $35 for my 100 quantity of share which I'm selling. It also shows you, for your ease, a break even here. That means if I go ahead and try to sell a call option for 10 with strike rate of $10, right? Hold on. Yeah. So yeah, if I go, my break even is 10.35. That means I'm going to get back this $0.35, but the other person who has bought this will actually, they will basically pay me $35 as a premium, so they will end up making the profit after the stock price is going more than that particular break even. Now it also shows you your chance of profit. So here, if you see, if you are able to sell this call, the chance of profit is 94%. These are usually statistically calculated and are available for your ease. Okay, let's go ahead. So now I'm going back to my original screen and I'm going to show you by proceeding with this $7.5 call. So in order to proceed, you will basically click on this general area of $7.5 call. Let's say we have gone through, we have done all our thing through an analysis, and now we want to sell this $7.5 call. So you will click basically in this general area of $7.5 call, and it will bring you to this screen. Now see what it is showing you. It asks you how many contracts or the how many covered calls you want to sell. By default is 0. You will have to put the quantity you want here. It tells you you have 605 shares available, right? And it's suggesting you a price which you should try to sell at. However, it also shows you here on the left side that this is where the market varies. I mean, market has up to $0.25 of price for, where people are attempting to sell this contract as well. So you should be able to play around with these numbers and manipulate it. So if I go to the next screen, here are the ways we can try to change it. I can, in this screen, I'm trying to sell just one contract. I could have sold up to 6 contracts because I had 605 shares, but I'm just attempting to sell one contract at 0.13. So that means if the share price does not go above $7.5 at the end of November 15 here, I will get $13 in my account because it is 0.13 into 100. Now, instead of this one quantity as 0.13, I can also change this to one quantity, and because the market price is going between 0 and 0.25, I'm saying I want to sell this one quantity at $20 a share, 20 cents a share. So it will give me basically $20 for my 100 shares at the end of November 15 if the share price is not gone above $7.5 of strike rate. And here, instead of just selling one quantity, I'm just changing the quantity to two. I want to sell two covered calls or two call options at 0.20 a share, which is basically $20 for 100 shares and $40 for 200 shares. And I will get $40 at end of the November 15 if the share price has not gone above $7.5 by then. Okay, let us go to the next slide. Now, if everything is okay, and in my example, I'm going to choose this last option where I'll attempt to sell two shares at 0.20 a share, thus giving me $20 for 100 and $40 for 200 shares. At the end of November 15, if the price of the share does not go above 7.5. If everything is okay in that same example, which is just a repeat of the screen here in this slide, I have to click on this check mark button over here. If that is okay, the next screen will appear like this. It will basically summarize everything for me. It says in very simple words what we are actually doing, just to make sure. It says that you are agreeing to sell 200 shares of KALA at 7.5 dollars per share before or on November 15. If you are not asked to sell this KALA share by then, you will keep the collateral and keep the $40 of credit, exactly as I had explained to you guys earlier. Make sure everything is okay on the screen, read everything thoroughly, ensure you're okay. If you're okay, you see a swipe up to trade here. So go over there, click it, click and swipe it up. Okay, and next the screen will appear. It will show you a confirmation. Now I was doing this on a weekend, so that's why it says market are closed right now on your order placed on October 19 2019. This will be sent as the start of the next trading session. If you are doing this to when the markets are on, it will automatically go for the proceeding, right? After looking at this, make sure everything is okay and click done. Um Now your transaction is now submitted. First, usually once you submit this, it goes in the queued status, then it goes to pending status, and then it goes to placed status. Now, now note that just because you are attempting to sell this covered call does not mean it will get sold immediately, or even if it will get sold, because sometimes what happens, depending on the stock you have and depending on how the market conditions are, there's nobody to buy these covered calls in the market. Um, so once but it does happen often, right? Me and my family, we see that this is happening fairly often, and we have been able to transact in the covered calls very fairly often. It does depend on what kind of stock you hold, so do a little bit of research, see how what stocks you hold and how many option contracts are traded on those, how many covered calls or call options are sold on those, right? So that will give you some idea. So yeah, once you place this requirement, it will first go on queued, pending, and then play status. Once it is done and executed, it will appear in your basically on your home window of Robinhood, and it will tell you that you have sold this, right? It will appear on your home screen, ideally under where you own the stock. If you click on that KALA or whatever XYZ stock you own, if you go there, it will show you that you hold a call option which you had sold over here, right? Um Now note that, yeah, just cause you have I have left the sentence incomplete here. The last sentence is, just cause you have sold the call option does not you have attempted to sell the call option does not mean it will be always sold, as I mentioned earlier. Okay, I have it covered here. Just just cause you attempted selling does not mean it is sold. So make sure it shows as executed, right? Um, and what's the last point? Note that the money earned by you as premium or commission, which is $50 in our the diagram example or $40 in the Robinhood example, it will be given to you by end of the transaction, which is at the end of after the November 15, if the price has not gone above 17 and nobody has asked for it. It will not be given to you at the beginning by Robinhood, that is as soon as it gets sold. So you need to be aware on that. Let's go ahead. Uh, I guess yeah, we are at towards the end of the Robinhood. I do have some more points to cover, so stay tuned for a few more minutes. But if you're not yet, again I'll remind you to subscribe, like, and comment. It helps me and my family and my friends make more of these videos, and it really helps me in YouTube algorithm. Now, other thing is, I hope this video was helpful, and I think we have covered the covered calls and the covered calls using Robinhood so far. If you like this vlog, we also have certain more videos which might be of interest to you. So I'll put some links in the description, and also on the right side top here I will try to put some cards where you can click and try to look at those videos. What you see on my screen are a couple of videos we already have on this channel, so see how you like them and how you would want to use them, right? um, Okay, there's one more slide for some related videos. You might see some pop-ups here or towards the end of the video, which you can click to browse other videos. This was brought to you by Financial Vlog. Uh, and the last but not the least is disclaimer. I hope this was helpful to you. I'm not a certified advisor. At the time of making this video, which is I think around October 2019, I'm not associated in any way, shape, or form with Robinhood. I'm just using that as a tool for with my own discretion and preference. Now note that I've taken very good care to provide you the correct information. It is possible I might have missed something, so please verify as you need before you transact. I do not assume any risk at my end. This is basically for general and general purpose information and entertainment only. Use your discretion and read through this disclaimer. Subscribe. Again, I know I'm saying it again and again, but it really helps me. Subscribe, comment, and like. Thank you for watching, guys, and have a wonderful day. I will put all the related videos here at the end of this slide, and you can click and watch them as much as you like. Have a wonderful day, guys, and stay tuned. Bye bye.